set the data point here, and frankly, there is no clear pattern at play. We're looking at first data point, which is that in the run-up to the election, let's say 20 trading sessions, about a month, in 2004, markets fell by 8%. 2009, they were up by 8%. 2014, up by 5%. 2019, markets actually were flat in the run-up to the election. That is important. But the interesting bit for us this time, and they always say, what is different? Naya kya hai? This is the differentiating part. The FI holding, what Aisha and Kunal just discussed, the FI positioning in the F&O market is at a 10-year high, which means the number of short positions by foreign institutional investors are at a 10-year high. But similarly, the number of the positioning of retail in the F&O market, and bear in mind that the market participation by the retail category is also expanded, is at a all-time high. So it's like reverse. FIs are hedging by going short, retail is long, assuming that they expect a post-election rally. Is that a fair assessment, Nooresh?
So there is one way to look at the data. The data is in number of contracts, and the contract value for Nifty has gone down from 50 to 25. But even after cutting it by 50%, it is one of the larger short positions we've been in. And the fact is, if you look at it, FIs have been selling. They've been selling in cash. They've been selling in futures. But the fact is, if you look at DII money over the last few years, every year DII inflow has been higher than FIIs. And we are at the cusp of the time where DII holding will be greater than FII holding. So what really matters going forward is, post-elections, we are not even considering the fact that FIIs can become buyers. If that happens, the flow changes could be phenomenal in terms of market participation. We've not seen that for, say, we saw it in 2020 to 2021, and see the smoothness of that rally. We've seen it in 2017. So when DIIs plus FIIs become buyers, we are not in sync to understand what sort of moves can happen.
And I'll establish the data again with looking at the FI positioning in the cash market. In the month of May, which is about 15 days, foreign institutional investors have been net sellers to the tune of 37,000 crore. The same positioning in 2019 was negative, but 7,000 crore. And 2014, guys, it's not once upon a time, only 10 years, was 11,000 crore. So the FI positioning in the run-up to the election has been strikingly different. Bhasin Saab, break the data for our viewers. Are we in for a very sharp rally which could be fueled by foreign institutional investors who right now have a short exposure and they've been selling in the cash market, and if markets like the election verdict, we could see a monster bout of short covering, which is that foreign institutional investors will be forced to cover their positions?
Yeah, good afternoon. Well, I would expect something like that if the results come as per what the market is looking and you get stability. Because Nikunj, what has changed is that global cues have become very positive. The Dow is 40,000, China market is back, Indian macro and micro are looking good, rainfall is good. So I think in the bonhomie, the people who are missing out or who have, who are opting for China or whatever, there will be a huge bout of covering. I would take that as a selling opportunity. So I think domestics will sell heavily once the FIs come and you hit new highs. And I think that is very much on the card. I would say 80% probability.
Sandeep, but what is making the FI fraternity that nervous? It can't be only elections, right? I mean, there is a lot of debate about whether money is moving to China and Hong Kong kind of markets or back to the US. What's really happening?
Yeah, so it's a combination of everything. It's nothing to do with India except the valuations. So FIs are not selling because of election uncertainty, X, Y, Z. It's just pure valuations. They see Indian markets have run up so much. They see profit opportunities. And Chinese markets were depressed so much. If you see the rally in the Chinese market, whoever shifted out of India into China has actually made big money. Then money shifted to Europe. Money shifted to Japan. So many countries have seen flows, and finally the pool of money is the same. Yeah. So it has to, so we can't always be getting money. Yeah. So that's not necessarily negative. I think what it does is that it provides some stability to the Indian market because domestic flows are so strong. So Nifty, I think if we see today, is up 3% this year, right? YTD is up just 3%.
Nothing actually.
So which is okay. So FIs have been selling, domestic investors have been buying, markets have been stable. So markets need that phase of stability and consolidation also, which is happening. Foreign investors will return to India. When will they return? I think once it gets established that US inflation is clearly on the way down, US dollar starts to weaken, I think India, including all emerging markets, will get substantial foreign investor flows. And it's a matter of time now. So whether it happens next month, 2 months later, 3 months later, we don't know.
Okay, so I'll
If you like this video, then like, share and subscribe to ET Now.